Thomas, let's focus on another company, Ugro Capital. Well, the stock has been in focus. I think if you pull it up over the last few months, today it's up close to around 0.5%. But in the last few months, well, the stock has seen a bit of a jump, particularly in the last 3 months or so. I think after they came up with their operational performance, pull up a 1-month chart, the stock has seen a bit of a bounce. Last 1 year, as flat as can be. To understand what's going on, what's the way ahead, we're joined by Mr. Nath, who is the Executive Chairman and Managing Director of the company. Hi, Mr. Nath. Good morning. Thanks so much for joining in. Well, I was just going through some guidance that you've given, and I believe that from around the 6,500 crores AUM, you're looking to take it to around 20,000 crores. Run us through, how you're going to get this done, point number one. And point number two, could you tell us about the asset quality? Because the fear is when you're growing your book at a fast clip, the asset quality could see a bit of a stumble. What's your outlook on both these two fronts?
Nigel, I will just take 1 minute to give you, because most of your viewers and the listed public market hardly knows that there is a listed fintech called Ugro. Ugro was started in 2018 when I acquired a small shell listed company called Chokhani Securities. Simultaneously, I raised roughly around 1,000 crore of capital, which came from 4 large private equity investors, TPG, Newcrest, Samina, ADV Capital, and PAG Asia. And our idea was to use the emerging data set of GST Banking and Bureau, create a highly specialized lending platform, and build India's largest small business financing platform. We were very clear that as Bajaj has done in consumer finance, next decade and a half belongs to the small business financing, because the traditional method of underwriting and assessment of SME customer would dramatically change and shift as more and more small businesses would keep coming in GST net. Starting from there, our first year was just post ILFS, 2019-20, wherein we deployed our equity capital of 850 odd crore. Then there was 1.5 years of shutdown due to COVID, but we rapidly expanded our base and infrastructure. In 2020, from a 9 location, 150 people company, we have grown to almost now 2,000 plus people company with almost 100 plus location. Our digital infrastructure has grown from 5 people to 250 plus people. So the growth which you are seeing is a function of our high early investment into building the infrastructure to cultivate the growth, because we see the immense opportunity. So we did 850 crore in year 1, 1,350 crore year 2, and once our entire infrastructure got set up in 22, we were at 3,000 crore. In 23, we were at 6,000 crore. We are on a run rate disbursement of 600 crore a month. And that's why we are confident on, reaching roughly around 10,000 crore, and that will catapult to, the guidance which we have given. Second, in terms of your question of the risk to the portfolio, almost it's a function of selection. Today, for a 600 crore disbursement, our login to approval rate is roughly around 30%. So we generate around 2,400 crore worth of MSME loans every month, end up disbursing 600 crore. So that's the selection. Second is the methodology. Ugro is India's tech-driven lending platform, where our assessment of cash flow predominantly by GST Banking and Bureau.
Okay. Mr. Nath, just wanted to touch upon the asset quality which Nigel alluded to, because your restructured book had at one point hit 7% of your total loans, though you have reduced it. What does it stand at currently, and what are the trends in terms of gross NPAs that you can give us some color on?
Yeah, so actually our restructured book, we have demonstrated an extremely good quality portfolio all through the COVID. Our current restructured book is roughly around 1.5% of total asset under management. So once the first restructuring came in our book of around 1,000 plus crore, we provided restructuring opportunity to all our customers because we are flushed with liquidity. And since then, almost 90% of that book is current and paying, and so we don't see any pain on that. In terms of the future of, we believe that we create our portfolio of what we call from a low yielding portfolio to mid yielding portfolio. So 70% of our portfolio is secured. All large portion of that portfolio is in lower yielding of 11 and 12%. And that's why we believe that next year we'll be in the range of credit cost of 1.5 to 2%. So we reverse engineer our credit cost by mixing the portfolio. We don't go into higher. We continue to believe that in India, there is a yield to loss ratio curve, and the way to give a predictable credit cost is to mix the portfolio in a manner wherein you don't become too greedy into go all the way to a higher yielding portfolio, but you have to mix and match it.
Right, and the guidance comes up for our viewers on the screen. FY25 guidance of 20,000 crores, ROA of 4.5%, ROE of around 18%, and leverage is around 3.8x odd, right? So we've got those numbers, Mr. Nath. Final question though, before we let you go. Looking at the stock price, and from the top actually it had come off a goodish bit. And there's one shareholder, DBZ Cyprus Limited. They held closer on 19.5% stake at the peak. Now that's come down to around 3.2%. I think they've been selling consistently over the last few quarters. Are they done and dusted? I mean, have they managed to sell everything? Are they still holding on? Because that will be a bit of an overhang.
Yeah, I think not many people pick it up. Nigel, you have picked it up very rightly. One of the reasons why we are trading at near to 1x book value and 0.9x of our forward book value, while we recently raised around 350 crore of equity capital, which came from Denmark government plus some of the large insurance company in India. DBZ is an investment vehicle of PAG Asia, which, as you know, is a $56 billion fund. DBZ's fund vehicle, which invested in Ugro, life was over last year. So they had no choice but to divest. Also, strategically, we found it right because given that large percent of our ownership is in the hands of PE, so we felt this can provide liquidity to the stock. So they have been selling in the market. Most of that had got consumed in retail. Our shareholder base has gone up from 900 shareholders to 12,000. Actually, now they are left with not more than 1 million shares. So I think so this is almost done. And that's why we think so that the selling pressure from one large investor is over, and stock should we should be fairly valued where we should be.
Interesting. One part of I get your argument, but maybe if there was so much of demand and so much of interest going by your growth outlook, maybe other large shareholder could have come and picked it up. But that's market dynamics for you. We get your